Hi everyone! Today I'll be discussing choosing the right entity for your business after the tax reform. So before you start a business, you should ask yourself, what is the best entity to shield me from liability? What is the best entity to save taxes? How does a new tax law impact my business? Corporation or pass-through entity? If pass-through, then what type of pass-through? I have a basic entity chart that can be used as a tool to explain the choice of entity that works best for your business. Let's run some basics for those of you that are totally unfamiliar with entity choices. So just to start with the basics here on ownership, first question to ask is who's going to own it? Is it just you? Or you and 10 business partners? Or you and a bunch of investors? That's going to derive certain type of decisions. So for the ownership, sole proprietor is going to be individuals. And for C Corp, it's going to be one or more shareholders. For S Corp, there's a limit of 100 shareholders. And for partnership, it's going to be 2 or more partners. And for LLC, it's going to be 1 or more members. If it's 2 or more members, it's going to be taxed as partnership. And who's going to have control? For sole proprietor, it's going to be the owner of him or herself. For C Corp, it's going to be board of directors. Same goes for S Corp. For partnership, most likely it's going to be depending on the partnership agreement. And for LLC, it's going to depend on the LLC agreement. How is the income going to be allocated? For sole proprietor, it's going to be 100%. And for C Corp, it's going to be 100% to C Corp entity because they're taxed separately. For S Corp, since it's a pass-through entity, it's going to be pro rata based on the shares. For partnership, it depends on the partnership agreement. And for LLC, it's going to depend on the tax election. I'm going to discuss more in detail later in the video on how the income is allocated and how they're being taxed. Now for liability purpose, in case your business gets sued, who's liable? For sole proprietor, unfortunately there's no limit. The judgment creditors can go after your personal assets. For C Corp, it's going to be limited to capital invested. For an S Corp, it's also going to be limited to capital invested. For partnership, there's no limit for GPs or general partners. And there will be limitation for LPs or limited partners. For LLC, it's going to depend on the capital investment. Now, how are the losses going to be treated? For sole proprietor, it's going to be treated just like it follows your individual rules. And for C Corp, it's going to be trapped at the corporate level. S Corp is going to be passed to the shareholders. For partnership, it's going to be passed to the partners. And depending on the tax election, that's going to determine how the losses are going to be treated for LLCs. And for self-employment tax, do you have to pay it? For sole proprietor, yes. For C Corp, no. Only the wages that are distributed. For S Corp, again, no, only the wages. For partnership, only to the general partner. And for LLC, it depends on the tax election. And lastly, how is the income going to be characterized? Well, for sole proprietor, it's going to be depending on the income. And for C Corp, it's going to be treated as a dividend to shareholders. For S Corp, it's going to be passed to the shareholders. Same thing for the partnership, it's going to be passed to the partners. And for LLC, it's going to depend on the tax election. If your business earns money, you will have to pay taxes on those profits. How you pay those taxes will depend on how you have structured your business. So it's important to understand what type of business you have formed and how you will have to pay tax on your business's profit. So every business from, let's say, selling pens on Amazon as a part-time gig to a Fortune 500 multinational company has a legal structure. The four basic legal structures for the business are sole proprietorship, partnership, LLC, and corporation. For tax purposes, corporations are either S corporations. These are corporations that have elected pass-through tax treatment, or C corporations, also called regular corporations. Every business falls into one of these categories, and your category will determine how your business's profits will be taxed. As I mentioned before, there are four legal structures for a business. Sole proprietorship is a one-owner business. The business owner personally owns all of the assets of the business and controls its operation. You can't be a sole proprietor if two or more people own the business, unless you own the business with your spouse. So for spouses who co-own a business, prior to 2007, spouses who co-owned a business were classified as a partnership for federal tax purposes, unless they formed a corporation or LLC or lived in a community property states. Now, married couples in any state who owns a business together may be able to elect to be taxed as sole proprietors. This doesn't reduce their taxes, but it does result in a much simpler tax return. Partnership. It's a form of shared ownership and management of a business. The partners contribute money, property, or services to the partnership. In return, they receive a share of the profits it earns. The partners jointly manage the partnership business. Although many partners enter into written partnership agreements, no written agreement is required to form a partnership. It automatically comes into existence whenever two or more people enter into business together to earn a profit and don't incorporate or form a LLC. So what's an LLC? It's a limited liability company, and it's like a sole proprietorship or partnership in that its owners are called members, jointly own and manage the business and share in the profits. However, it's also like a corporation because its owners must file papers with the state to create the LLC. It exists as a separate legal entity, and its structures give owners some protection from liability for business debts. Lastly, corporations can only be created by filing an incorporation document with your state government. A corporation is a legal entity separate from its owners. It can hold title to properties, sue and be sued, have its own bank accounts, borrow money, hire employees, and perform other basic functions. For tax purposes, there are two types of corporations: S corporations, also called small business corporations, and C corporations. The most important difference between the two types of corporations is how they are taxed. An S corporation pays no taxes itself. Instead, its income or loss is passed on to its owners, who must pay personal income taxes on their share of the corporation's profits. A C corporation is a separate tax-paying entity that pays taxes on its profits. How is your business going to be treated for tax purposes? Your business's legal structure will determine how it is treated for tax purposes. There are two different ways business entities can be taxed. The business itself can be taxed as a separate entity, or the business profit or losses can be passed through to the owners, who include the profits or losses on their individual tax return. The pass-through entities are sole proprietorship, partnerships, LLCs, and S Corp. So sole proprietorship and S-corp are always pass-through entities. LLCs and partnerships are almost always pass-through entities as well. Partnerships and multi-owner LLCs are automatically taxed as partnerships when they're created. One-owner LLCs are automatically taxed like sole proprietorships. However, LLC and partnership owners have the option of choosing to have their entity taxed as a C Corp or an S Corp by filing an election with the IRS. A pass-through entity does not pay any taxes itself. Instead, the business profit or losses are passed through to its owners, who include them on the IRS Form 1040. If a profit is passed through to the owners, that money is added to any other income the owner has, and the owner pays taxes on those total amount. If a loss is passed through, the owner can generally use it to offset income from other sources, such as salary from a job, interest income, investment income, or spouse's income if filing a joint tax return. The owner can subtract the business loss from this other income, which leaves a lower total subject to tax. Owners of pass-through entity qualify for a new pass-through income tax deduction of up to 20% of their business income under the Tax Cuts and Jobs Act. This was discussed in detail in my video. Find out how landlords and business owners can qualify for the Section 199 Cap B deduction, so I invite you to watch the video for thorough understanding of the pass-through deduction. Although pass-through entities don't pay taxes, their income and expenses must still be reported to the IRS as follows. Sole proprietors must file IRS Schedule C profit or loss from business with their tax returns. This form lists all the owner's business income and deductible expenses. For spouses who co-own a business, if a couple doesn't choose or qualify for sole proprietor status, then each spouse carry his or her share of the partnership income or loss from Form 1065 Schedule K1 to their joint or separate Form 1040. Each spouse should also include his or her share of self-employment income on a separate Form 1040 Schedule SC. Spouses in all states who jointly own and manage a business together can elect to be taxed as a qualified joint venture and treated as sole proprietors for tax purposes. A couple elects to be treated as a qualified joint venture by filing a joint tax return. Each spouse files a separate Schedule C to report that spouse's share of the business's profits and losses, and a separate Schedule SE to report his or her share of the self-employment tax. That way, each spouse gets credit for Social Security and Medicare coverage purposes. Now, for spouses in any of the 9 community property states may elect qualified joint venture status. However, couples in these states can also choose to classify their business as a sole proprietorship simply by filing a single Schedule C listing one spouse as the sole proprietor. For many couples, this is easier to do than qualified joint venture status because there is no material participation requirement. One drawback to this election is that only one spouse, the one listed in the Schedule C, receives credit for Social Security and Medicare coverage purposes. Partnerships are required to file an annual tax form, Form 1065 U.S. Return of Partnership Income, with the IRS. Form 1065 is not used to pay taxes. Instead, it is an information return that informs the IRS of the partnership's income, deductions, profits, losses, and tax credits for the year. Form 1065 also includes a separate part called Schedule K1, in which the partnership lists each partner's share of the items listed on Form 1065. A separate Schedule K1 must be provided to each partner. The partners report on their individual tax returns their share of the partnership's net profit or loss as shown on Schedule K1. Ordinary business income or loss is reported on Schedule E, Supplemental Income and Loss. However, certain items must be reported on other schedules. For example, capital gains and losses must be reported on Schedule D and charitable contributions on Schedule A. S corporations report their income and deductions much like partnership. An S corporation files an information return, Form 1120-S, reporting the corporation's income, deductions, profits, losses, and tax credits for the year. Like partners, shareholders must be provided a Schedule K1 listing their share of the items listed in the corporation's Form 1120-S. The shareholders file Schedule E with their personal tax returns showing their share of corporation income or losses. Unlike with the other pass-through entities, S corporation owners ordinarily work as employees of their corporation. This can help them maximize the new 20% pass-through deductions. An LLC with only one member is treated like a sole proprietorship for tax purposes, so the member reports profits, losses, and deductions on Schedule C just like a sole proprietor. An LLC with two or more members is treated like a partnership for tax purposes unless the members elect to be taxed like a C Corp or an S Corp. Regular C corporations is the only business form that is not a pass-through entity. Instead, a C corporation is taxed separately from its owners. Like any other business, a C corporation is entitled to deduct its business expenses. It must then pay income taxes on its net income at the C corporation tax rate and file its own tax returns with the IRS using Form 1120 or Form 1120A. You pay personal income tax on C corporation income only when it is distributed to you in the form of salary, bonuses, or dividends. Starting in 2019, the tax rate for a regular C corporation has been reduced from a top rate of 35% to a flat tax of 21% on all C corporation income. If you are the owner of a C corporation, any direct payment of your corporation's profits to you will be considered a dividend by the IRS and taxed twice. First, the corporation will pay corporate income tax on the profit at the 21% corporate rate on its own return, and then you will pay personal income tax on what you receive from the corporation. This is called double taxation. C Corp dividends are usually taxed at capital gains rates. Higher income taxpayers must also pay a 3.8% Medicare tax on net dividend and investment income. The tax rates on dividends range from 15% to 23.8% for high income taxpayers, and dividend payments are not deductible by the corporation. There are tax benefits that come with the C Corp employee status. The tax law allows a C Corp to provide its employees with many types of fringe benefits that it can deduct from the corporation's income as a business expense. And employees need not include the value of the fringe benefits in their taxable income, effectively making these benefits tax-free to them. Possible tax-free employee fringe benefits include health, accident, and dental insurance for you and your family, disability insurance, reimbursement of medical expenses not covered by insurance, deferred compensation plans, working condition fringe benefits such as company-owned cars and group term life insurance. With pass-through entities, on the other hand, there are no tax-free employee benefits available to the owners. C corporation versus pass-through tax treatment. How to choose what's best for your business. The Tax Cuts and Jobs Act reduced the tax rate for regular C Corp from a top rate of 35% to a flat tax of 21% on all C corporation income. For the first time in decades, corporate tax rates are substantially lower than the income tax rates paid by higher income individuals. At the same time, the new tax law created a brand new deduction for pass-through entities, allowing them to deduct 20% of the net income from their business, a huge tax savings. So which tax treatment should you choose? So let's go over some super simplified calculation here. We have a corporation, pass-through entity, and individual. For pass-through entity and individual taxpayer, let's assume highest marginal individual rate and qualification for pass-through deduction. For $100 income for corporate taxpayer, the corporate tax rate is 21%, so that will be $21 of corporate tax. And the dividend tax would be $18.80 with 23.8% dividend tax rate. Since 20% pass-through deduction and marginal rate doesn't apply to a corporate taxpayer, the total tax is $39.80. That is $21 plus $18.80 of corporate and dividend tax. For pass-through entity with the income of $100, and we're going to assume that 20% pass-through deduction applies, the marginal rate of 37% would make it $29.60. And with high income taxpayers, there will be a 3.8% net investment income tax. So that would make the total $32.64. And for individuals with income of $100, none of the corporate tax, dividend tax, or the 20% pass-through deduction applies, so the marginal rate will be 37% plus the 3.8% of net investment income tax being taxed with the $100 income. That will make it $40.80. So the total tax for individual taxpayers is $40.80. There are so many factors involved in choosing which entity is right for your business that the only way to evaluate whether forming a, for example, C corporation might be a good idea is to have a CPA crunch the numbers for you. As a general rule, a C corporation will only be advantageous if you can avoid double taxation by keeping a substantial amount of money in your corporation to expand your business and or provide employee benefits, rather than distributing it as dividends. Money you keep in your C corporation business is taxed only once at the 21% rate. If your income is over $500,000 if you're single or $600,000 if married, you'll be in the top 37% personal income tax bracket, and the 21% C corporation rate will be most beneficial. This is particularly true if you provide a personal service, because at these income levels, you won't qualify for the pass-through deduction. Total tax savings. When you add up your savings in federal, state, and self-employment taxes, you can see the true value of a business tax deduction. For example, if you make $80,000, a business deduction can be worth as much as 22% in federal income tax, plus 15.3% in self-employment taxes, plus 6% in state taxes, depending on which state you live in. That adds up to a whopping 43.3% savings. So if you buy a $1,000 computer for your business and you deduct expense, you save about $433 in taxes. This is why it's so important to know all the business deductions you are entitled to take and to take advantage of every one. Of course, don't buy stuff just to get a tax deduction. I hope this video managed to clarify in choosing the right entity for your business. And if you like this video, please subscribe and give me a thumbs up.